My name is Memo Ringui. I'm going to talk to you today to just give some highlights in terms of some of the remuneration trends and salary survey data interpretation in Zimbabwe. As you would notice that salary issues are really topical, but I would want to just briefly touch on the economic situation in the whole of Southern Africa as it impacts on issues to do with remuneration. As we noted, most economies in the SADC region are in distress, largely as a result of COVID, even before the COVID pandemic. This was already evident that economies in Southern Africa were going to have challenges in terms of growing. And as a result of this, about 45 million people are estimated to be food insecure by the start of 2021. And this has been considered to be the highest in a decade. And some of the economic sectors affected within the whole of SADC include tourism, which is one of the most affected sectors because it largely depends on the movement of individuals from one location to another. Manufacturing is another one. Financial services. Manufacturing was largely affected by disruption in supply chain systems across the globe. But probably one of the sectors that has done very well in terms of technological and digital migration is the financial service sector. Some of the effects of COVID controls implemented largely within the SADC region include issues to do with the border post, closing of border posts, and shutting down of informal traders. These are so crucial for economies, especially in Africa and largely in Southern Africa. Just a brief background in terms of why salary surveys, because I want to highlight this because most of the information that we get come through salary surveys. Salary surveys are a tool that most organizations use either through consultants or through themselves to collect information about competitive information, salary information on the job market. Not easy information to get, but important information in any case that any organization would need to collect in order for them to periodically check whether their salaries are competitive or not. We'll talk more about this in terms of interpretation at the end of the presentations. And the salary surveys, they are really based largely on job titles, the size of the employer, industries, but I'll give more details later on. Let's just look at remuneration trends in Africa. About 3/4 of the labor force in Africa works in the informal sector, and that 3/4 basically looking at 75% of roughly more than 75% of those employees working in the informal sector. And this tends to cut across most of the African countries. If you look at research by Conferry, they estimate that salary increase for Africa for 2021 are going to average 5%, but this is largely excluding countries that have got high inflation, as increases have been much more than that already. And wage and salaried employees account for about 15% of total employment in Africa, low-income countries, and 20 to 35% in non-mineral exporting countries, which is a smaller share of the mineral-rich countries, as you would notice. Of these proportions, public sector employment accounts for about 1/3 of the employment in low-income countries, then 1/6 in low to medium income countries, and almost half in resource-rich countries. So the public sector does employ quite a significant number of people that are considered to be informal employment in many countries. The other point to take note is that labor costs are still very high, even in this country. We have heard people complaining about their products not being competitive largely as a result of labor costs. And this is an issue that people need to take note of, because labor costs do play a big part in terms of how companies are competitive. So the cost of labor is still very high in most African countries. Some of the reasons, obviously, demand for high-level skills, especially those skills that are in the private sector. And in the public sector, you find that most of the public sector organizations struggle to attract top talent, largely as a result of lower wages, especially across Africa. Although employment is stable, but we've seen now, even in South Africa, where retrenchments or reduction of headcount is also taking place in a number of public entities, in a number of government departments. as a result of restructuring of economies. And there's also fierce competition from the NGO sector, which is basically considered more stable, although this sector has been largely affected by funding constraints due to the COVID pandemic, especially those that are not related to health and related functions. African countries generally follow similar remuneration policies and practices, although Zimbabwe is a bit unique in some instances, as I will show you. Francophone and Lussophone countries, for example, have laws and practice that are typically considered to be more employee-friendly compared to Anglophone countries. This is as a result of this coming from a research done by Sarah in South Africa. Then you also find, depending on the nature of the economy and things like that, some of the benefits tend to reflect what is happening. If you still remember, during the hyperinflation period, we ended up buying groceries for staff. It was because of the situation at that particular moment. So there are also unique issues that tend to relate to the economic situation of a country that are not found in many other countries. But probably one of the many issues that Zimbabwe is still struggling with, which is probably not predominantly happening in other countries or changing in other countries, is the issue of providing a motor vehicle, a fully expensed company vehicle, which is a common trend in this country. So understanding your local needs and customizing your remuneration to your own specific needs tend to play a big part in terms of what then you end up practicing as an organization. About 8% of jobs were lost from last year due to COVID in sub-Saharan Africa. If you look at Kenya, Nigeria, and Ethiopia, almost 1 in 3 household enterprises closed at the onset of the pandemic. We do know that the informal sector is more resilient, but it has been affected largely by the COVID pandemic, and this is a big issue. In Gabon, South Africa, South Sudan, Malawi, Uganda, Madagascar, and others, revenue declined for most households by more than 70% in terms of their business. As would be expected, this drop in income has led to reduction in consumption, and this is a key factor for anyone who is running a business, especially those that are running profitable businesses. Once consumption starts going down, it means demand for your products will also start going down. And in a majority of the cases, especially those in informal sectors, they started selling some of their assets in order to survive during the COVID pandemic. And we are still seeing those struggles happening. According to the MESA report, more than half of the companies in Africa provide what is called a performance bonus. Although if you go deeper into some of the performance bonus practices, you will notice that there is very little relationship with actual performance, either at company level or at individual level. Although half of the companies in Africa claim to operate some form of performance bonus, including in this country. The average proportion is 15% of basic annual salary. These are bonuses that are given as a percentage of annual salary or as a percentage of monthly salary. But if you go up there in Cameroon, you find the percentage tend to go up. Then guaranteed annual salary is supplemented in the form of 13th check, especially here in Zimbabwe. We still see that quite a number of companies are still offering the 13th check, which is obviously an outdated model of remunerating people, as it has nothing to do with whether the individual performs or not in most cases. And some of these 13th checks have already been negotiated at the National Employment Council level as a guaranteed income, which is actually a bit risky for organizations and HR professionals in general to be able to go that route. In Africa, there appears less correlation between GDP and the consumer price index and annual salary increases. What it means is that, which means the salaries are being adjusted regardless of changes in the cost of living sometimes or production output. We have seen that, yes, trade unions tend to push that, but in the majority of cases, you find that this is not the case. So on average, if you look at Africa, basic salaries constitute about 50 to 60% of what someone earns, while other allowances make up about 20%. Then other guaranteed cash payments make up about 15 to 20%. In Zimbabwe, we have seen this to be changing. In some cases, you find that allowances are making up close to about 70% of what someone is earning. In some cases, much more than that. But there is no tax benefit to it if you look at this country. But if you go into other jurisdictions, you find that if you offer certain allowances, you tend to get tax benefits. In Western countries, for example, you find that CEOs are paid about $320 on average, although the maximum sometimes is about 3,000 times more than the lower paid employees. The recommended is about 1 to 10, which means 10 times the lowest paid employee. That's the recommended. Normally, if you want to have issues, if you don't want to have issues with your unions and staff, you must make sure that your highest pay or the average pay for executives is on average 10 times more than that of the lowest paid. Others tend to use the average pay, not necessarily the lowest paid, but these are all computations that HR professional must be able to do. Because normally once that ratio starts going up, for example, 1 to 10, if it's 1 to 30, 1 to 500, 1 to 50, all those numbers start finding that employees start getting disgruntled. And in such cases, they start highlighting issues to do with the unfairness of salaries within the organization, and that is a major issue. For those that are interested in learning more about pay disparities, you can actually go to what is called the High Pay Center. Just Google the High Pay Center. They've done a lot of research on pay disparities and pay equity in a number of countries, and you find lots of reports, although the focus has largely been on CEOs. That's what we find. Then when we look at Zimbabwe specifically, let's look at the cost of living. This is our own cost of living tracker that we have used. You can see the exponential growth of that particular line, which means from March 2020, we started seeing a cost of living going up with a slight drop in around the festive season in 2020, but it's on the upward trend again. We don't know what direction it will take, but it would seem that we are on an upward trend in terms of cost of living. And if you go to our Human Capital Hub, you find this free service in terms of the cost of living. So that's basically the anchor, because most of the salaries are negotiated or discussed on the basis of cost of living, not necessarily on the basis of how the company is performing. And that is a challenge for most businesses. When you look at the companies that participate in our surveys, we have seen that 41% of them offer what is called the cost of living allowance, which is they consider to be temporary. But we have also noticed that most of these companies end up giving this cost of living, transferring this cost of living allowance into a permanent remuneration. Because once you start giving employees some form of remuneration, very difficult to take away, is to give, but very difficult to take away. So it is going to be compounded into the salary, either as a basic salary or as some form of allowance into the remuneration of an individual. So close to about 50% of the employers do give some form of cost of living allowance. This, remember, it started during the COVID period, started before the COVID period, when organizations were not too sure whether they will be able to sustain any cost of living allowances on a permanent basis because of the way companies were performing. So this is a point to take note. Then when you look at wage bill proportion by job level, you will find that these are the distributions. But obviously, this is specific to sectors. This is on an average for the national data that we have. You find that that's the distribution, with most of the salaries probably going to the professionals and junior managers. But also, depending on if you're employing large numbers of lower level staff, you find that the percentage increase of the percentage contribution of your NEC staff is much higher. Then when you look at allowances on general at national level, you notice that it's almost 50-50 between basic salary and allowances, largely because of the multiplicity of allowances that organizations are giving. And this is probably something that we can discuss. There is no intrinsic value in some of the allowance names that we are seeing on the market. For example, someone was getting a danger allowance and many other allowances that we are seeing on the market. Remuneration is remuneration, whether it's called an allowance, whether it's called a basic salary, it's all remuneration. The only issue is that with the basic salary, you tend to calculate some of your your remuneration components based on the basic salary. For example, overtime, issues to do with the pension, and many other things that are linked to the basic salary. But probably we need to start reorienting ourselves to a stage where we just start talking about remuneration earnings without necessarily distributing it in terms of these multiple allowances that we are seeing on the market. Then when you look at sectorial level, when we do this service, we do by IPC level. And when you look at sectorial level, you find that this is largely the distribution in terms of average salaries across sectors. Not much difference across many sectors, except for specific levels. When you look at this, you notice that the top levels in millions now, roughly, which is an equivalent of what people were earning around 2015, 2014. Or those salaries were at their peak around 2011, when we had CEOs, for example, at that time earning roughly about 17,000 on average. That has tended to go down, as many companies cannot afford. But still, in the current circumstances, you will notice that there are others who can still afford those kind of salaries. So most of the salaries have moved upwards in Zim dollar terms, although majority of some of the exporting companies do pay in US dollar terms. So those are the averages when you look at some of these salaries across all sectors. So you know, if you are an HR executive, depending whether you're director level or not, the salaries are around 700,000 up to $1 million in some instances, depending on the affordability of the company. Or if you are HR business partner, you're looking at around 300,000 to about 400,000. That's the kind of salary that you are earning there. Then when you go to, this is just an example of a total cost. When you look at the total cost level, the figure that we gave you there may not reflect the total cost. If you go to the total cost of employment, you will notice that there is convergence in terms of sectors. Salaries tend to really be, the difference start narrowing when you're looking both. So in some cases, find a company is offering a fully expensed company vehicle, another one is offering a loan. But when you put it together in terms of total cost, these salaries tend to converge. You don't see those differences. But when employees are looking for jobs, most of the time they tend to itemize and look at those differences. If someone is driving a good car, for example, and someone they've bought their own car, probably a Hilux or any of the 4x4s, the moderate 4x4s, you find that people start comparing and making those comparisons in terms of those vehicles. If you look at an HR officer, these are the average salaries across some of the about 136 in terms of national average. But again, be reminded that averages are misleading to some extent, in the sense that they are largely affected by outliers. If we throw in someone who is a lower paying company, that tend to pull the average down. If we throw in a high paying company, that tend to move the average up a bit. So these are all considerations that you need to work on as you're looking at some of these numbers. But important, then we also, there are also a number of allowances that organizations are giving across the board: transport, housing, lunch, medical aid, and fuel. And these tend to vary by level. For example, lower level staff tend to get transport, and some of the companies have started providing buses and things like that. There are questions, obviously, in relation to how sustainable long term are these. Is this the right way to go? Probably unique in Zimbabwe in terms of employers providing transport in the form of buses and many other amenities that employers are providing. How sustainable and competitive can we be if we continue on this path? But this is open for discussion across for us as HR professionals to look at all these. These benefits are given for sustainability of work. For example, if the company is located out of town and you're collecting people from, transporting people from a distance location, which is a dormitory town, you need to transport them. Housing, it's sustainability of work, sometimes lunch, medical aid, and fuel. But we do also have other benefits that are called lifestyle benefits, which are not necessarily related to how the person will do the work. That's supposed to be cell phone. The spelling is wrong there. These are called benefits that are given as a result of competitive necessity, and not necessarily as a result of performance or any other factor. For example, cell phone, if you are not in sales, there's no need really for you to buy a cell phone, for example, for your executive, although it's common. Why would the executive fail to buy their own cell phone? School fees, assistance, there's no particular reason for giving this besides competitive necessity. It doesn't necessarily follow that those people who are getting school fees allowance are going to perform better or they are giving you special value. There's no connection at all. So it's basically a lifestyle issue and given for competitive necessity. Then professional membership is the same, club fees is the same, company vehicles is the same, except for very few roles that are really depending on a company vehicle to be able to do the work, for example, like your sales staff and business development personnel. Then pension contributions, again, it's a lifestyle issue, looking into the future and financial security of the employee, again, given for competitive necessity and also, in some cases, regulatory requirements, meeting regulatory requirements. So in terms of what you should give, as an HR professional, you need to be able to categorize all your benefits, whether they are actually promoting sustainability of work, or they are promoting, you are just giving them as a result of competitive necessity, because competitors are giving that. So for purpose of retention, you would want to retain employees. But also remember, there's ample research to show that all these benefits, very few of them are actually linked to any performance of the individual. So if you give anyone these, there's no connection between how they're going to give more, whether they're going to give more value or not. So that's a challenge. When you look at percentage increases across from 2019 to 2020, according to our data, there was a jump in 2019 to almost 900% increase. In 2020, when you look at 2019 and 2020, largely because of that's when we experienced a bit of that inflation bout that we experienced. Then 2020 to 2021, averaging so far, we are looking at roughly about 397%, but it's largely driven by companies that did not do anything in 2020 that were lagging behind. But the majority of companies are probably on the conservative side in terms of increases. When you look by level, you will notice that the levels there, your executives and the NECs, just look at the figures there. But again, they are still approximating this type of graph. That's what we are seeing in terms of percentage changes. 2019, not much change, sorry, a jump 2019 to 2020. Then some of the changes that we have noticed, salary change every year. The rate of increase obviously slightly higher for other levels and not others, but I have already shown you in that particular graph. One of the areas that I want to just pay a bit of attention on quickly is on the issue of company vehicles. About 20% of companies are on total cost model and provide a vehicle allowance. Then about 29% are running two models, that is the vehicle system. They are running both the total cost and the vehicle system for various reasons. Some are still migrating. Some are experimenting to see which one works, but we are seeing that largely majority of the companies are moving towards total cost to company, largely because of the costs that are involved in running and replenishing the vehicle fleet for staff, especially if you've got 30, 40 managers, imagine, with an average cost of a vehicle around 75,000, and that is money to recapitalize the business. If you look at 40 people times 75,000, that's a lot of money, and this is money in USD terms. And it's not small money. Currently, companies have not been able to give vehicles loans in some cases, largely because of the cost of vehicles on the market. Others had to go down and reduce the amount of vehicle loans that they're allowing their employees to access, largely because employees cannot afford to repay those on the current salary levels. But that gap is being bridged slowly as we see a bit of stabilization on the Zim dollar side, and some of the car dealers are also accepting Zim dollar payments, but still very difficult. So these are all challenges that we are seeing on the market. So we have already talked about that. Then due to increase in cost of living every month, companies should restructure their wages in terms of recommendations on wages before I go briefly on how to interpret the salary surveys. As you are looking at the market, you must always be cognizant of the fact that whatever you're going to recommend as an HR professional must be something that is sustainable for your business, something that you can afford as a business, because affordability is one thing, sustainability is something else, because you can afford today, then 3 months down the line, you may actually fail to sustain the wages that you're talking about. So you need to be extremely careful, and I applaud those that have gone on if you are not sure about the stability and performance of your business, I applaud those that have gone on a discretionary allowance of some sort to cushion employees, and this discretionary allowance can be changed regardless, depending on the performance of the organization. Again, we recommend that if you can go to total cost, you remove a number of distortions in your pay model if you go the total cost to company model. Lastly, just a bit of interpretation on salary surveys. I indicated at the beginning that salary surveys are very important, specifically for collecting information on the market. But we do face challenges as consultants, for example, in terms of collecting salary surveys. Some HR professionals indicate they don't have authority to share this information. Others just reluctant to share this information. But for those that have got the power, those that are empowered, it's a one email or a phone call based on the relationship that we have with them, and they participate in the survey. And we hope that as more and more people, HR professionals, get more information, we will be able to get to a stage where we go like South Africa. If you look at our salary surveys currently, when you collect information from companies in Zimbabwe, for example, you can't actually share and say, you know what, you've done this manufacturing salary survey for the market. 10, 15 companies participated. Here's the list of companies that has participated. Most Zimbabwean companies don't want their names listed, which is unique. If you go into any other jurisdiction, they actually list the number of the participants. It could be an issue to do with, obviously, challenges to do with confidentiality of information, and the people scared that if their information get leaked one way or the other, they may be in trouble. But that's a practice probably as HR professionals who need to run away from, because employers, those that are buying and purchasing salaries, they just want to see the sample size and the sample content of the people that they participated in order for them to make informed decisions. So if you go outside in South Africa, you rarely get a salary survey where the participants are not listed, but in this country, it's not like that. So salary surveys are very important for you in the sense that even if you are not going to pay to adjust your salary, you just need to be aware where the salaries are in terms of the market for various sectors. Because in some cases, employees don't necessarily have to move in the same sector. For example, employees don't move from manufacturing to manufacturing. An employee can move from manufacturing to banking and vice versa, or mining to banking and vice versa, especially for those that are cross-cutting. HR, finance, business development, some engineers, a number, probably 70% of roles can actually move across sectors. So it's actually a bit misleading for you sometimes to just confine your data or your analysis to only your sector, because sometimes you don't get the clear picture and you keep on losing stuff as a result of that kind of approach. Okay, so our salary survey is conducted. We choose a target population either by product, region, or sector, labor market, headcount, balance sheet size, or operating budget or revenue. These are all factors that we consider. We actually, the process of making sure that all our surveys conform to all those, and our analysis will look at headcount, labor market, balance sheet size, or operating budget, especially for those that do not have income or that depend on surplus rather than depending on actual profit. Revenue, these are all issues. Then choosing a sample and collecting data, all these are issues that I'm going to briefly talk about. Why a salary survey is very difficult to conduct? Disparities between salary survey information, consumption, and participation rates in salaries. People want salary survey information, but they don't want to participate in the surveys. Even in some sectors where probably 50% of the HR professionals are not interested in surveys, but the demand for salary survey is very high in that sector, and I don't know how that information can be collected if people are not willing to participate in the salary surveys. Because the consulting firm is the arbitrator in terms of collecting neutral information and then consolidating. In some sectors, the good beauty about some of the sectors is that they actually come together and then call a consultant and say, can you collect information on our behalf as a sector? We just want to see how we are doing in terms of salary for the particular sector. So lack of empowerment of the custodian of this information, especially HR professionals, majority of them, probably 70% of them, will tell you they have to seek authorization, they have no authority. But we do have others that are senior enough or empowered enough, and they don't need to consult anyone in terms of participating in salary surveys. Sampling that we do is basically convenient sampling. It's because of the scarcity of this information, it's not possible to do a random sampling. Then how do you choose a sample size? We basically look at the margin of error and the confidence interval that we require. Choosing job titles. For example, you may find that when we are reporting, this is how we look at the information. We look at the grade, number of incumbents, number of organization. We can actually do weighted analysis of this information based on this kind of information. It's all important. But the most difficult part of any salary survey data that you as an HR professional must be aware all the time, regardless of who has done the survey, is the matching of jobs. Because an HR officer in one organization is completely different in another organization. And that is a reality. The second reality is that job evaluation systems have got disparities. There are inaccuracies in them. Even if one organization grades an HR officer as a T2, role, another one can grade the same HR officer probably with lesser responsibility, a D4. And that already if you're going to compare on titles, it's going to give you a distortion. And even if you compare by grades, it's still going to give you a distortion. Even those salary surveys where they give you a snapshot of the job, it still brings inconsistency. So, and there is more research that needs to be happening in this area so that the matching of jobs becomes much easier, but it's the most difficult part of any salary survey. For example, how different are the duties of a chief finance officer and the FD? The jobs are basically similar in some cases. Titles are misleading. In some cases, just to give you an example, you find that in other cases, you find HR, in HR, for example, HR business partner is not interpreted the same across businesses. HR executive is not interpreted the same across businesses. HR director is not interpreted the same across business. In some cases, the title HR director is in some cases actually less in terms of scope for some HR executives or even for an HR business partner. So all these issues are issues that are of concern that we, as HR professionals, probably need to come together. So there are so many distortions across salary survey data, regardless of who is doing it. If they're not more careful, it's actually even more difficult. But also remember, there are problems already in relation to job description themselves. Even if you go and ask for a job description from a company, because the problem is that job descriptions are copied from one company to the other. Some Google them. They are not a true reflection of what someone does unless they are done properly, which I have noticed in most organizations, they are not done properly. They're done for job evaluation, they're done for recruitment, but to go to the core of what someone is actually doing. Sometimes you give a job description and the person is only doing 50% of what is in the job description. And those are issues that then bring distortions. We are working on a model that we think probably will address some of these issues, a more scientific model that will probably address some of these challenges that we find in salary surveys. Okay, so then how usable are some of these survey information? You need to ask that question more frequently because if there is stability, even salary surveys that have been done 3-5 months ago, they can still be useful. But in a hyperinflation kind of environment, they lose value more quickly, and you need to take that into consideration. When you are doing the analysis, the best way to look at salary surveys in terms of information is avoid looking at averages a lot, because averages tend to distort information or they are vectored by outliers. Focus on the median, or what is called the 50th percentile, or focus on the percentile. They tend to give much better information than the averages. Okay, so when you're looking at percentiles, I'll show you an example later on. One of the things that I've talked about, I will not waste a lot of time on it, is that when you're looking at the market, let's take, for example, you've got an HR manager who earns a total package of $3,000 at company X. The median total package is 3.5. The compa ratio for this HR manager is 86%, which is 3,000 over 3.5. Okay, you can see there. So when the compa ratio, you're taking what the individuals in your organization is earning versus what is your target market. For example, if the HR manager is earning $3,000 and the market is paying 8,000, you do that as a percentage, it gives you a compa ratio. The compa ratio range required, or standard compa ratio, is 80% to 120. And anything outside that range is pointing to a problem within your remuneration model or the distribution of your salaries. But also take note that more competent staff must be moving towards should be moving towards the 100% compa ratio in an organization. So if they are around 80% potential underpaid, if they're around 80 to 120 salary within range, above 120 it's potentially overpaid. Not in all cases that they're underpaid or overpaid. You need to dig deeper into that. So the calculation, you'll see it when you get the presentation. There is also what is called range penetration, which measures the extent to which an individual has progressed within a minimum, from the minimum salary towards the grade maximum. That is called range penetration, and it's calculated. A salary of 8,000 at a range penetration is a range penetration of 41%, which is 8,000 minus 6,000 for grade 1, divided by the maximum, obviously maximum minus minimum. That gives you the range penetration. Rarely used, but a very useful analysis that you can do there. We have taught this in the pay structure workshop that we have done before. I think I've talked about that. Range spread basically the minimum between the percentage difference between your minimum salary and a maximum salary per grade. And you also need to look at that. I know a lot of people talk about notching. It's not advisable to use notching, especially if you want to move towards performance management or performance related pay. Notching, the challenge is that people get fixated to notching. Instead of using notching, you must use merit tables rather than using notches. Are not advisable, predominantly found in the public sector. Even in the public sector in this country, they are no longer there. If you look at it, very few, because it's an old-fashioned kind of managing salaries that you need to get away from. Okay, that I will not go into that. Just look at this example as the last slide that we can look at. Interpreting salary survey, you can see the grade, the count. The count is saying how many positions. Did we look at the average market 20-50 percentile there? The 20-50 percentile just the lower quarter. Okay, so if you are paying at the market 20-50 percent, you are paying better than 25% of the bottom. We are in the bottom category basically. If your salaries are falling within the 25%, within the lower quartile of the market, then median or 50th percentile, you are basically middle of the road. You are in the middle of the market. Then 75 percentile, you are in the top 25. Then 90th percentile, you are in the top 10 of the paying public. At the end there, you'll find most of our reports have got what is called the coefficient of variation. The bigger this number, the more varied the salaries for that particular level. For example, if you look here, it means 120% coefficient of variation means salaries at that level are more varied, more widely varied than salaries at grade for the IT manager, for example, 54%. The lower the spread, if you go into NEC roles, you find that the coefficient of variation is around 2%, 3%, which means there's not much variability in those salaries for NEC levels. So chances, if the coefficient of variation is very low, chances of someone leaving your organization and go and get to go to another organization, get a higher salary is very slim. But if you look at these numbers, for example, here, you'll notice that someone who is a CEO, if they move from one organization, they've got potential to earn as much as 120% more than what they are earning currently, based on the coefficient of variation that we are seeing there. So those are issues that you need to look at. I think we've already talked about the range spread, how people are paid. In terms of how people are paid, normally, remember, we said we target the 50th percentile there. That's most companies target the 50th percentile. And also make sure that everyone moves toward the 50th percentile, but predominantly those that are performing. Once you go toward the 50th percentile, you rarely lose staff at the rate that you would consider above the benchmark of 5% turnover. That is normal, considered normally globally. Okay. Then other people tend to ask questions about whether pay structures should be overlapping. Yes, a good pay structure should have overlap, but not too much. But a pay structure with no overlap is a disaster for your organization. It leads to what is called pay compression in the organization. So you must avoid that. But we can talk more about this in the pay structuring presentation that we will do sometime in the future. Thank you. I can take questions briefly. Are there any questions? If you've got any questions, please just unmute yourself and shoot. You can ask any questions. Since there are no questions, thank you very much. Enjoy the rest of your day.